Hi, good morning, everyone. Thanks for joining the weekly research morning call. Today we have quite a few stock contract updates like Apple, Microsoft, or First Rate, and followed by the Euro technical pulse and Singapore weekly. Yeah, so this is our Euro disclaimer. Yeah, so basically it's for educational purpose only. Yeah, so without further ado, I'll hand over to Helena for Apple. Helena, please.
Thank you, Mel. So I start with Apple. Their second quarter earnings were within our expectation. First half revenue and PMI were at 51 and 54% of our forecast. Their revenue grew 5% year on year, mainly still driven by the growth in services, and gross margin expanded 0.5% year on year. Their iPhone sales remain pretty muted. It only increased 1.9%, and they have continued weakness in China, which decreased 2.3% year on year. So moving on to the positive, the usual one is they still have strong services growth. So services has actually seen the sixth consecutive quarter of low double-digit year-on-year growth, as fueled by the rapid scaling of their recurring subscription offerings. So looking ahead to FY25, we expect services to play an even bigger role in bolstering the overall profitability because they're expanding store base. So it kind of pushes its revenue contribution higher. Now its contribution to the overall revenue is 27.8% compared to 26% a year ago. And because services has a very high margin, so I think that's going to really help with Apple's profitability. The second positive point is they have announced to invest $500 billion in their US operations. They have also announced plans to source specific components like chip and glasses from domestic suppliers in response to the rising tariff. So we view it as a it's a plus in the long term because it kind of reduces its independence of overseas suppliers, which would definitely help them mitigate risk for global disruptions. But however, this increased short-term capex and higher cost of sourcing component. So all these will pressure the free cash flow and weigh on gross margin. We expect gross margin to shrink 0.6% to 1.6% for the next quarter. Moving on to the negative, the one that concerns us the most is the tariff. The tariff will definitely pressure earnings. Management has guided that the impact of tariff, considering no change to current backdrop, could be around $900 million for the next quarter, which is surprisingly pretty low. But that is to take account that they still have the benefit of preemptive inventory management. So when that benefit starts fading out, they did mention that the impact for the further quarters would be much higher, though they didn't really provide any color on how much it is. So from our own estimation, we estimate the impact on the cost of goods sold would be around $1.5 billion per quarter, and that could potentially lower the FY25 and 26 PMI by 2% and 4% respectively. And the other negative that they have is they're still struggling in iPhone and China market. So iPhone revenue only rose 2% year on year, which we think is a little bit disappointing given that they introduced multiple Apple Intelligence features like writing tools, Gemoji, Image Playground, ChatGPT integration. So, and meanwhile, the revenue from China declined for the seventh consecutive quarter. And we expect further weakness ahead because they now face intensifying competition due to their rising production costs. So that's going to make them harder to even compete with the local brand. Moving on to the outlook, Apple expect the third quarter revenue to increase by low to single digit year on year. Services are expected to continue growing double digit, and we estimate product growth to be single digit. So Apple is also guiding their gross margin of 45.5 to 46.5%. So overall, we maintain a pretty cautious outlook on Apple due to their near-term headwind from tariff, their elevated capex, and persistent weakness in products in the China market. Their fundamentals remain pretty resilient, but we think the rising cost pressure and slowing iPhone momentum will definitely limit their upside. So in terms of valuation, we decreased our FY25 and 26 PMI by 2% and 4% respectively, like I mentioned just now, to account for the decreased gross margin due to rising tariff. We also adjust their FY25 and 26 capex to 1.2x and 2.3x to account for the higher investment in US operations. We maintain our recommendation of neutral with a lower DCF target price of $200. So that's all for Apple. I'll move on to Spotify. So for Spotify, we think the growth momentum still continues, but the valuation is pretty high already. So their first quarter 25 revenue was within expectations, but their PATMI actually fell short due to unexpected high social charges, which is 76 million, which is 58 million above their forecast. So this is really driven by a surge in their recent share price. So their first quarter revenue and PATMI were at 24 and 10% of our FY25 forecast. User metrics, they ramp up. MAU ramp up to 678 million, which is a growth of 10% year on year. Premium subscriber grows healthy as well. It grew double digit at 12% year on year. So moving on to the positive, we think the first one would be their revenue remains really strong. It grew 15%. Premium revenue grew 16% year on year. So both are fueled by continued subscriber growth, like I mentioned just now, and a gain in their average revenue per user from the price increases. So this financial performance really reflect their continued ability to capitalize on their growing subscriber base and the ability to optimize pricing strategies. So management do say that they see themselves in a position to further increase prices, given its ability to really balance a healthy value to price ratio. The second positive point we think is their podcast monetization success. So they actually launched a program called Spotify Partner Program in January this year, which is a new monetization system for their video podcasters. So this program has rapidly expanded to 9 markets already. And the initiative has gained pretty strong momentum. We're seeing users spending 44% more time on video content overall. And their payout to podcast creators already exceeded $100 million just in the first quarter. Within Spotify, they do have the advantage in video podcasting because their closest competitor, which is YouTube, they lack a lot of background audio for free users, so making it less friendly for passive listeners compared to Spotify. It's still in the very beginning stage, but it kind of shows Spotify's strategic shift towards a more broadening of its content portfolio beyond music in order to drive a broader and deeper user engagement. And the last positive we see is management's commentary still signals a limited impact from the tariff. So they have clarified specifically that the short-term noise does not really explicitly relate to Spotify. They haven't seen demand really changing, and if not, they're actually seeing demand being more central to people's life. And we view Spotify's membership, they're pretty affordable kind of entertainment. They're starting at only $12 per month. So we do believe the demand is going to remain resilient even in a recession environment. And this is further supported by Spotify's own guidance for the next quarter. They guided a double-digit growth in revenue, total MAU, and premium subscription. But the negative, like I mentioned just now, their PATMI fell short due to their social charges. So Spotify, they do grant equity as part of their employee compensation. So when these shares vest, Spotify, they owe a social security tax on the market value of the shares. And because share price surged in the first quarter, the value of the various share rose, and so does their social charges. And we do expect the social charges to stay elevated due to Spotify's share price strength. Moving on to guidance, Spotify has guided a 13% year-on-year growth in revenue for the next quarter, driven by user and price growth. Their gross margin expected to expand 230 BPS to 31.5%. We think Spotify remains pretty resilient because they have very limited tariff exposure and strong earnings growth. They're also backed up by a pretty positive FY25 outlook. So the company does maintain its leadership in the industry, which is reinforced by their notable pricing power and improving margins. So we're really positive on Spotify, but to look at their valuation, it seems really full. Their FY25 PE ratio is 65x, which is significantly higher than the average tech company, which is already around 48x. So we keep our FY25 revenue assumption unchanged. We decreased our PATMI assumption by 4% to account for the extra social charges after their share price strength. Our DCF target price remains unchanged at $600. We downgrade our recommendation from neutral to reduce due to the recent share price strength. Yeah, so that's all from me. I'll pass my time to Farmi from Microsoft.
All right, thank you, Alina. Hi, everyone. I would be presenting for Microsoft. So Microsoft recently released their quarterly result for third quarter of 2025 last week, and we published our report this morning. The result met our expectation with both the revenue and PATMI at 74% of our estimations. They were able to release strong earnings and remains less impacted by the ongoing tariff because majority of the Microsoft earnings are driven by cloud-based offerings. If you look on the left side, productivity and business process improved by 11% year-over-year, and intelligent cloud improved by 21% year-over-year. This is driven by a high demand for Azure and AI services. Moving on to the first positive points highlight, Microsoft managed to deliver better than expected earnings. Their revenue grew by 13% year-over-year to $70.1 billion, which is approximately 2% above the company's guidance and consensus estimate. While their PATMI jumped by 18% year-over-year, which is approximately 7% ahead of the consensus estimate. The strong growth for this quarter is again driven by the Intelligent Cloud business segment, which grew by 21% year-over-year, and their main growth engines, which is Azure. Azure grew by 35%, outperforming their previous quarter's guidance of 31.5%. More importantly, management highlighted that AI services contribution increased by 3 percentage points to 16 percentage points from the previous quarter. The AI services contribution now make about half of the Azure and cloud services revenue growth, and double from the 7 percentage points in the same quarter last year. We don't see Microsoft services demand to go down in the near term, which is because this is backed by the company's high customer contracted backlog of $315 billion. Moving on to the second highlight, we see that Microsoft AI services demand outpaced its AI supply capacity. Management highlighted that increment in Microsoft AI capacity is going on as planned as they keep going on opening the data center. They have just recently opened up new data centers in 10 countries across 4 continents in this quarter alone. Microsoft AI performance had also improved by 30% while using the same power usage. Despite this increased progress in the AI supply, management emphasized that AI demand is growing faster than expected and anticipates some AI capacity constraint in the near term beyond June. Still, despite this constraint expected, they anticipate continuous high double-digit growth for Azure and AI services in the next quarter on continued cloud consumption. Third positive point is that Microsoft continued to improve their operating margin to 46% this quarter from 45% in the same quarter last year. We see this as a positive that they improved their margin despite their scaling their AI infrastructure from CapEx spending. The improvement was mainly due to the top line growth and continued operational discipline, with their OPEX to revenue ratio declined by 159 basis points year-over-year to 23%. Moving on to the outlook, Microsoft issued stronger than expected guidance for fourth quarter 2025, with total revenue to grow by 14% year-over-year. Intelligent Cloud revenue is expected to grow by 20% year-over-year, supported by Azure revenue growth of 34 to 35% year-over-year, which is up by 5%. This acceleration is to be driven by, again, strong demand of Microsoft AI services from their customers. They managed to keep approximately 30% growth in Azure for the last few quarters, and we think that is very impressive and foresee them to keep going with this growth. Microsoft growth story remained intact for this quarter alone. Management, they managed to show progress of AI development and, most importantly, continuously show earnings visibility, justifying their CapEx spending. For CapEx, for financial year 2025, total CapEx will remain unchanged at 80 billion. Microsoft expect fourth quarter to increase sequentially, the CapEx to increase sequentially, and for the financial year 26 of CapEx will have a greater mix of short-lived assets instead of long-term, which is more closely tied to the revenue and is expected to grow, which signifies and hinting higher demand, but at a slower rate than financial year 2025. And again, to be driven by strong demand for Microsoft services. So with that in mind, we downgrade our recommendation from buy to accumulate due to the recent price trend, and our DCF price target and financial year 2025 earnings forecast remains unchanged. That is all from me. I will pass to Glenn.
Hey, thanks, Fahmi. Yeah, so obviously doing a quick Phillip on the ground on iFast. There's been quite a lot of eyes on iFast recently, mainly due to the share price movement, right? I think after they released their results, which were generally quite positive, if you look at the first quarter figures, it was mostly up, right? If you look at their revenue, AUA, profit lines, even their banking business did relatively well. but I think the share price dipped mainly due to I think the main highlight for this quarter, which was that they lowered their Hong Kong e-pension business targets. So if you look at the Hong Kong segment alone for the first quarter, you can see that there was already a decline. I think it did by the profit before tax did by 7% year on year for first quarter, and this is really due to the higher expenses that they faced. So they had higher, I think they had higher manpower and operating expenses because they did not anticipate, or at least they did not prepare for the amount of people that they needed in order to shift the clients smoothly over to this new platform that they are managing. So that's why they had to hire more people and I think spend more money in order to ensure that this shift was moved smoothly. So in view of that, they realized that they would need to review their guidance. So they did lower their guidance down by around 12% from 500 million Hong Kong dollars to 380 million Hong Kong dollars for FY25's profit before tax for the Hong Kong e-pension. So this is quite a big, quite significant because the Hong Kong segment alone now with this e-pension business does contribute to roughly around 50% to their bottom line. Hence, I think that's why we saw the price, the share price react accordingly. On a positive note, if you look at the AUA, it has been continuing to grow. I think they're still on track to meet their 100 billion target. It's long-term 100 billion target. Their iFAST Global Bank has also achieved the second consecutive quarter of profitability. They're now hitting around 1 million bottom line kind of figures for the global bank. But I think if you look at it overall, right, the growth in this in their wealth platform as well as the sort of the profitability of the iFAST Global Bank will not really offset this decline in guidance of the Hong Kong segment, which they have guided down by 12%. So I think that's the reason why the market has also reacted as such. Yeah, so moving forward, I think this year will be quite a tough year for them because of this increase in expenses for Hong Kong side. But hopefully, the banking business will continue to pick up speed, right? And it could offset some of these losses that they are not losses, but lower profits that they are looking at for the Hong Kong side. And next year, the Hong Kong e-pension, they are thinking that it will be double digit. They haven't given any firm guidance, but we're looking at double digit sort of year-on-year growth across the gross net revenue as well as the profit before tax. Yeah, so I think next year then you'll see the speed picking up for them as well as with the global bank. So that's all for iFAST. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. Yeah, so for Class, their gross profit was up 4% year on year. During their operational update, Class, they won't disclose much financial details, but they only mentioned RevPAR and gross profit. So for them, their gross profit was up 4%. And for RevPAR, it was up 4% as well. If you look at it in the chart on the left, so you see Japan is down 11%, but that's mainly because they acquired one of the hotels that was at a lower, that has a lower ADR. So as a result, the RevPAR fell year on year. But if you strip that out, you exclude the acquisition, the Japan RevPAR was up 17%. Yeah, so the total in the first quarter, so they had higher occupancy of 77%. First quarter of last year was 73%, and going forward, we still expect the portfolio RevPAR to continue to grow in the mid-single digit levels. So with stronger countries like Japan offsetting the weakness in Singapore. Yeah, so on the Singapore outlook, I'll leave that to Meow Meow when she talks about FEHT later. For the borrowing costs, Class also they managed to have some interest savings. Their borrowing cost fell 0.1 percentage points. So now it's at 2.9%. And the gearing is expected to dip a little bit by about 0.3% following because they divested one asset in China, and the proceeds from that, when they repatriate, they'll use that to pay down some debt, and as a result, the gearing will fall some more to about 39%. Yeah, and for the cost of debt, it's expected to remain stable for the rest of this year. Yeah, so for the outlook, for now, forward bookings still remain stable for their properties, and demand is shifting towards the domestic and short-haul flights, So no impact from tariffs for now, but the second half outlook is still more uncertain. And the geographical diversification also will help to offset the softening demands in Singapore, as I mentioned. And right now, they still have over 330 million of undistributed divestment gains that they'll use to top up their DPU, especially in a case where one of the AEI, one big major AEI in London, Cavendish London, that goes under AEI, and there'll be some absence of income, and because of that, they'll use some of the undistributed divestment gains to top that out to at least maintain a stable year-on-year DPU for this financial year 2025. So right now for Class, there are stable income sources which comprises of master leases and management contracts from minimum guaranteed income. So that is very stable income. So it comprises 70% of the first quarter 2025 gross profit. So going forward, this a stable income source base of 70% will help to provide downside protection in case in a situation where there is a recession and consumer spending slows, and they'll still be supported by these stable income sources. So with that, no change of TP, and based on the stable year-on-year, the FY25 dividend yield is 7%, which we think is attractive for a CapitaLand name. Yeah, next slide, please. Yeah, so for FCT, they have defensive earnings from the suburban malls. So for the results, the first half results, it was in line with our expectations. So there were higher contributions from Tampines 1 post the AEI, and there's also higher rents from the positive rent reversion seen over the last year and this quarter as well, and as well as the base rental escalation. So if you exclude the Tampines 1 AEI and the divestment of Chinese City Point last year, the MPI was up slightly 1.6% higher. So that is based on organic growth, that 1.6%. And for the distributions from investments, it was up quite significantly. But that's mainly because of the additional stake that they took in Next, additional 24.5% stake, which was completed last year. Yeah, so for them, retail portfolio occupancy remained very stable at 99.5%. So that is super high. With that high occupancy, they can continue to have strong bargaining power with the rental renewals. And their rental reversions for the first half was at 9%. So it ranged from about 5% to 13.3% for all the malls. So it's a very broad-based kind of increase. And for Tampines 1 specifically, post AEI was up 13.3%. Yeah, so for them, tenant sales and shopper traffic continues to improve. So it was up 3.3% for tenant sales and 1% for shopper traffic. If you strip out the Tampines 1 AEI effect, the tenant sales was still positive. So that is a good sign. And further things that will help to support these tenant sales are like government support measures like your progressive wage model, your SG60 vouchers, CDC vouchers, all these will help to uplift sales momentum going forward. Yeah, and for FCT, they also benefited from lower cost of debt. So it's now at 3.9%. It quarter on quarter, it dropped by 10 basis points. And it's expected to remain at similar levels for them. And for them, gearing is at 38.6%, and they have no more refinancing risk in FY25. And they are still pending the EGM of the North Point City South Wing. They are still looking to raise a $200 million perp. So that is slightly in current market, maybe around 4.3% coupon. Yeah, so for now, Hougang Mall, their AEI is already 64% pre-committed to date. Works at the mall have already started. So it's slated for completion in the third quarter, and the mall will continue to remain operational. So it's something like the Tampines 1 AEI where they'll close a small part of the mall each time to do the AEI works. And for them, the occupancy cost is still low at under 16%. So that is extremely low. Normally it's around 17 to 18%. So that gives room for them to keep increasing their rents. And there's also limited supply coming over the next few years. And all this will help to support the potential for strong rental reversions, especially for the suburban malls. Yeah, but we downgrade our recommendation to an accumulate. That's mainly because of the recent share price performance. The share price rose quite significantly over the past few months, or rather past month to be exact. So our target price is unchanged, and FCT is paying a yield of 5.5%. Yep, next slide, please. So move on to Stoneweg. So for Stoneweg REIT, their performance was very resilient. If you exclude divestments and redevelopments, the MPI was up 7.4%. So NPI basically was up 2.4% mainly because of some of the divestments as well. But for their results, the indicated DPU was in line with our estimates. Yeah, so for the positives for them, they continued positive rent reversion of 1.7%. Their light industrial logistics portfolio was up 4.7% and office was down slightly. When the current market conditions, it's better to renew leases at lower for office at lower rent reversion than keeping it vacant. So that's still a positive sign. And on top of that, their portfolio is unrented by 7% compared to market rents. So there is still room for positive rent reversion. And they had a very significant renewal recently. So that is the support renewal. So they are looking at rents that are 40 to 50% higher than previous rents, and that will kick in the second quarter of this year. So that we will be expecting very high positive rent reversion in the second quarter this year. And there's strong capital management as well. So they do not have any loans due until the fourth quarter 2026 after they refinance the bond, which resulted in a higher interest rate for them for this quarter as well. So as you can see, the net finance cost, it rose, but that's mainly because of the new bond issuance. They issued a new bond at 4.2%, and that is used to repay the 2.125 bond that which expires in November 2025. So as a result, they experience a jump up in interest costs. And on top of that, they also entered into a new 150 million euros of hedges using a cap collar structure. So this structure is better so that they can benefit from interest rates coming down as well. Yeah, and that will extend the hedge cover to 73% in 2027. So right now it's at 89%. There are percentage of loans that are hedged. Yeah, and after refinancing that loan, or rather the bond issue and with the bond issuance, the only cost of debt we expected to remain stable or come down even slightly from the lower 3-month Euribor. So right now it's at 4.16%. Yeah, so Stoneweg, they are poised to benefit from more ECB rate cuts. So they're going to do a mid-year valuation. So for that, we're expecting some at least valuations to remain stable, but it's highly likely that they will get some positive valuation uplift. So that's from cap rate compression as well as some of the significant leases that are signed under the office sector. So likely we'll see a positive valuations for both logistics and office. So over the past few valuation cycles, we saw logistics portfolio continue to improve in valuations while the office sector saw declines, but now we think it will be a turnaround. And for Stoneweg, they have a new sponsor, Stoneweg. So Stoneweg European REIT, they can leverage on their new sponsors pipeline, so mostly logistics and data center exposure for more inorganic growth. And they've also just recently stapled the new business structure to the REIT. So this new structure will enhance tax efficiency and operational flexibility, and also increase the investment opportunities to perhaps invest in data center developments as well. So Stoneweg, they are benefiting from structural trends such as nearshoring and increasing defense spending across Europe. So all these will help to drive demand for the manufacturing logistics assets, which they have a strong presence in. Yeah, so with that, no change to our TP. Maintain our buy call, and Stoneweg is trading an attractive 9% dividend yield, despite the fact that we accounted for the new bond issuance at almost a 2% higher than the previous issue. So Stoneweg is trading at an attractive 9% yield, which we think is very, very attractive. Yep. Next slide, please. Yeah, so moving on to First REIT. So their operations were really stable, resilient. So their gross revenue was just impacted by higher the stronger Sing dollar against the Indonesian rupiah and Japanese yen. So they're just hit by FX, but in local currency terms, operations remain very stable. So quarter on quarter, the DPU was also unchanged, and year on year is down 3.3%. Yeah, so just a reminder that First REIT is still one of the REITs that pay quarterly dividends. So usually most REITs now, they pay half-yearly dividends. Yeah, so for the positives for them, like I mentioned, their operations were resilient. Their rental income in Indonesia, it grew by 5.5%. Just to recall, they have a 4.5% base escalation for the whole Indonesian portfolio. So this increase of 5.5% is just higher rent from the performance-based rents from 3 hospitals. So organic growth from them going forward will be more performance-based rent more hospitals on performance-based rent. And for them, they also benefited from lower interest rates. So it's a 30 basis point quarter-on-quarter decline to 4.7%. So their hedging ratio is also low at 56%. So they'll benefit from more interest rates as interest rates continue to come down. And for JPY, they're fully hedged until the end of the year. Indonesia, they are still currently not hedged, but that's because they're undergoing a strategic review. And for Siloam, they issued a letter of intent to acquire all of their hospitals. So yeah, because of that, they are not hedging the Indonesian hospital because of this uncertainty. And for the negatives for First REIT, they managed to collect 2.4 million in fourth quarter 2024, but since then they've not received any payment. And because of that, the rent continues to increase, the rental in arrears continues to increase, and now they owe 5.8 million in rent. Yeah, so for the strategic update or strategic review, there's basically no material developments from that from Siloam's letter of intent to acquire all of First REIT's hospital assets in Indonesia. But one thing to note is that Siloam, they have already secured a syndicated loan of 1.1 billion to potentially acquire all of First REIT's hospitals in Indonesia. So just to recap that First REIT's, assuming that Siloam, they take on this loan of 1.1 billion, right, is to fully fund the First REIT hospitals. And First REIT hospitals, the AUM is about 850 million. So we are looking at like perhaps a 30% premium to the valuations for this acquisition. So First REIT will likely benefit if assuming that this Siloam's new loan of 1.1 billion is taken fully to finance that. Yeah, and so no change to our TP, 32 cents, and First REIT is also trading at an attractive yield, 9.2%. Yeah, next slide, please. So moving on to my last update, CLI first quarter update. Yeah, so the revenue and the REIB was down quite significantly, 24% and 44%. That's mainly due to the deconsolidation of CapitaLand Ascott Trust. So if you recall, Class was previously consolidated, but since December 2024, they sold down a 4+% stake. So now their stake is down 24%, and as a result, they deconsolidated Class. So that was why the revenue was down so significantly in this quarter. And their recurring FRB remains resilient. So it's up 3% for this quarter, and total fee-related FRB is also up 3%. So their target is to hit 10%, but in this current quarter, it was noted that the event-driven fees remain under pressure due to the heightened geopolitical tensions. So this quarter is expected to remain weak, and both buyers and sellers are taking a more cautious approach and wait and see approach, and probably decision makings will likely be pushed back towards the end of 2025. Yeah, however, for them, the recurring FRB remains resilient, like listed fund, logic, and commercial management, grew by 4%, 8%, and 4% respectively. Yeah, FUM is still quarter on quarter is stable at 117 billion, and right now 109 billion is deployed. Over the quarter, they also raised 1.1 billion, and that includes a 5 billion RMB mandate with a Chinese domestic institution to invest in core strategies in China. And they've also made 1.5 billion in investments, and that includes the 944 million Osaka data center development that they had already announced. Yeah, so for CLI, the impact to tariffs will more be a second order impact, and there's minimal disruptions as expected in the near term, and forward bookings for them is still very resilient. So the second half is more uncertain, but at least for now, the second quarter is still very strong, especially for their lodging assets. And operation conditions in China still, as you all know, still very challenging. So negative reversions across all the sectors, and their low debt to equity or gearing ratio of 0.939 times. Yeah, that provides them with ample liquidity to for acquisitions and inorganic growth to reach the 200 billion FM target. Yeah, so just to recall, they acquired SCCP and Wingate. So yeah, more acquisitions to come, and that will likely boost them towards that 200 billion FM target. Yeah, so no change to our call and our SOTP TP of $3.65, and CLI is also paying a not bad attractive yield of 4.6%. Yeah, that's all for me. I don't have time now to meow meow. Thanks.
Thanks, Darren. So Far East Hospitality Trust released the first quarter 25 result last week and is in line with our forecast. For positives, revenue from commercial segment increased by 4.9% year-on-year to 4.6 million. And this is supported by a single-digit rental reversion and a 5.3 percentage point improvement in occupancy rate. And the cost of debt is also on the downward trajectory. It declined by 0.2 percentage point quarter-on-quarter to 3.5%. And we do expect cost of borrowing to trend marginally lower for the full year 2025. And for negatives, hotel RevPAR declined by 6% year-on-year, driven by a 1.4 percentage point year-on-year drop in average occupancy and also a 4.4% decrease in ADR. However, we do expect recovery in international tourism to continue support ADR growth, as there's still a 6.6% percentage point gap between the current occupancy rate and also to pre-COVID levels. And for outlook, FICE shared that the forward booking for second quarter 25 remain healthy, as Singapore continue to position itself as the Southeast Asia's premier entertainment hub. And this is supported by a very robust pipeline of the international concerts, such as Lady Gaga, and also upcoming MICE events like the LIV Golf Singapore and Semicon Asia, Semicon C 2025. And Far East Hospitality Trust also completed its recent acquisition of a 319 rooms upscale hotel in Japan. Yeah, so it's called Sheraton Nagaya. Yeah, so the initial purchase price is around 52 million Singapore dollar, with more than 20% discount of its last valuation. And yeah, so the hotel is located at Expo and also international airport of the city. And the acquisition is fully funded in Japanese yen with cost of borrowing of 1.7%. Yeah, that's why the overall cost of borrowing has been brought down to like 3.2%. Yeah, so overall, we do see potential DPU upside to coming from the interest cost saving part and also capital top-ups. As cost of borrowing inched down by 0.2 percentage point quarter-on-quarter, and is also expected to decline further with a recent secured swap at a lower SORA rate. And in addition, they also have 9.7 million undistributed proceeds from the divestment of Central Square. So we do expect some DPU top-up this year. And the Far East Hospitality Trust is trading at FY25 dividend yield of 6.9% and 0.62 times price to NAV. And moving on to Elite UK REIT. First quarter results was in line with our forecast. DPU increased by 9.6% year-on-year. And something positive is that Elite is in negotiation with early renewal of its largest tenant, Department of Work and Pension, which accounts for 95% of the total gross rental income in first quarter 25. So they plan to renew 25% of the space by the end of this year. And because of the under-rented rental, which they currently sign with DWP. So Elite expect a 20 to 30% positive rental reversion upon successful renewal. And they also placed one of its biggest asset, Peel Park, which is valued at 33 million and accounts for roughly like 8% of the overall portfolio. So they placed the asset into the market for divestment, and so far they have been receiving offers and evaluating it, and they already secured 60 megawatts of power And they are pending like 120 megawatts. Yeah, so this is pending regulatory approval. So we do expect the investment to be completed by the end of this year, at a price at least 50% above the latest valuation. And this is so this was supported by its proven track record and also very robust demand for data center in UK. So assuming all the proceeds to use to pay down debt, gearing will drop to below 40% range by the end of this year. And Elite is also converting one of its property to special built student accommodation. And the rough construction timeline is 9 to 12 months. Yeah, so we do expect cash flow to be generating from second half 26 onwards. So they are targeting at a high teens ROI, and there will be 40 to 50 million capex, and this will be funded through debt. Cost of borrowing for Elite is also trending down. It declined by 40 basis point year-on-year to 4.8%. And they do expect further 30 to 60 basis point interest saving in FY25. Yeah, so Elite is trading at forward dividend yield of 9.7% and a price to NAV of 0.7 times. Yeah, that's all for me. I'll hand it over to Ding for technical parts. Thank you.
Thanks, Melville. Good morning, everyone. I'll move on to the technicals. So first up, this is the chart on S&P 500. Last week continued to rebound. It was up 2.9% for the week. So yeah, managed to hold above 5,450 level and above the red line, which is the 50 MA. So I think for now, we are likely to see some sort of resistance in the near term, given that the rebound from the bottom is about 17%. Key resistance would be likely at 5,750, which is a swing high form at the end of March before the Liberation Day sell-off. There's also two key moving averages resistance at this level as well, which is the purple line and the green line you see in the chart, which is the 100 as well as 200 MA levels. Yeah, so for now, overall, resistance likely to be at 5,710 to 5,850. Support likely to be at 5,525 to 5,600 area. Next slide. Okay, so we have our ETF Monday April. So we titled it Rebound for S&P 500 US Treasury Bonds and Hang Seng Index in May. In terms of the performance for different ETFs in April, it was quite mixed. Top gainer was Bitcoin, which surged 13.7%, and the top loser was oil, which tumbled 15.9%. In terms of their current trends, most of them are in the range consolidation. Gold is in an uptrend and oil is in a downtrend. And for outlook for May, we expect S&P 500 US Treasury Bonds and Hang Seng Index to be in the green, while gold, oil, Bitcoin, as well as Singapore equities could pull back in the month. Next slide. So I'll go through each of the ETFs. First one is the S&P 500 ETF VOO. So we saw a recovery above the $504 level after the sell-off towards the end of April, as well as it broke above this short-term downwards resistance line. So I think in the near term, we are likely to see price continue to go up further to probably retest this 530 key resistance level, which was a swing high before the sell-off in the start of April. So that could represent about from the current level, from the current last close price, maybe another 1.7% upside before we see maybe a bit of a consolidation afterwards. Next slide. Next one is the Treasury Bond ETF IEF. So this one, in terms of the trend, is still quite range bound, mostly between $94 to $97. So in start of April, it just came back to 94, held as support, and a bit of rebound afterwards. So perhaps you could try to test 97 again and continue a bit of a range bound trading afterwards. Next slide. And next one is the Gold Mini Shares Trust GLDM. So for Gold, very strong performance, trading above the uptrend channel. However, in terms of if you look at in terms of the Bollinger Bands in the chart, it's starting to pull back from the upper Bollinger Band. So similar to previous instances in April as well as October, November last year. So after a very strong momentum, we are likely to see some cooling off, a bit of a pullback, perhaps towards $62 breakout level. So yes, some slight pullback to be expected this month. Next slide. Next one is the oil and gas ETF, so XOP. So this one we can see there's weakness when there was a significant breakdown below 122, which was the key support level which held from July of last year. And then it actually reached sold off towards the $100 level before rebound. But we expect this XOP to find some resistance from this around $113, $114, which is the current level from the current downtrend. So we expect it to turn down in May to continue its weakness. Next slide. Next one is the Bitcoin ETF BITU. So this one also staged a strong recovery with a breakout of a short-term downwards resistance line and back to retest around the $20 previous range support breakdown. So over here, we're likely to see a bit of a pullback after a strong rally, but there's a bit of consolidation taking place at the start of this month. Next slide. Next one, Singapore Equities ETF, ES3. So for this, also recovery to retest around close to $3.90. I think at this level, there's expected to be some resistance, as we are currently seeing the Singapore market quite sideways right now as well. So just doing a retest of this uptrend channel breakdown currently, we expect a bit of a slight pullback consolidation for this month. Next slide. Yeah, then for the Hang Seng Index ETF, so for this one, pull back towards the rising wedge support and around below $80, and currently we're seeing a bit of a rebound. So I think we could see some sort of a further recovery towards above $87, which was a previous support level before the gap down and the sell-off. So perhaps a little bit more upside hit. Next slide. Yeah, so next one is our Thai SDR monthly. So this one, the title is that we expect most Thai SDRs to extend their gains in May. It was a good month for the Thai SDRs in April. All of them were in the green except one, which was PTT, which was down around 14%. For Delta Electronics, it was the top gainer, was up almost 50% because it had a large decline previously. Those are current trends. Most of them are in the range consolidation. PTT is in the downtrend, and Kasikorn Bank is one of the strongest in the uptrend right now. For outlook for me, we expect most of them to extend their gains, which are Airports of Thailand, CPO, Kasikorn Bank, Siam Cement, Advanced Info Service. PTT is likely to extend its weakness, and Delta Electronics, we expect some sideways consolidation. Next slide. Yeah, so first up, Airports of Thailand managed to overall still some weakness, but we see some short-term recovery coming back with the breakout of this downtrend channel in the short term. So we could see some potential recovery hit as it could try to hit to test the $41 to $44 resistance again this month. Next slide. The next one for CPO, mostly sideways, but ended off the month quite decently. I think we could see a breakout of this downwards resistance line this month to sort of try to test around $53 to $56 this fringe resistance area next. Yeah, so possibly a bit of an upside ahead this month. Next slide. Next one for PTT. Yeah, so this one we can see the chart is still quite weak, trading in the overall downtrend. A bit of a rebound took place, but we likely to see it try to retest the descending broadening wedge support again, which is the blue lines. So that could bring it back down to retest the recent lows close to about 91 to 93 level. Next slide. Next one for Kasikorn Bank. This is one of the strongest SDRs. So breakout of this range consolidation at $150, and it's form a higher high. So we expect this momentum to actually continue going ahead. Could hit towards above 160 to 170 area to continue its short-term bullish momentum in May. Next slide. For Siam Cement, a bit of a recovery from a bit of a higher low in April, above $125. So we could still see perhaps try to retest the recent swing high close to about 168 and above. So then afterwards, we'll expect a bit of a slight consolidation. So perhaps a bit of a upside as it try to rebound to retest the recent swing high level. Next slide. Then for Advanced Info Service, I think this one is also something to watch out for. It's also mostly trading in range consolidation for a long time since last year. Key resistance here at 293, but it has retested this resistance for about 4 times so far. So I think there's a good chance that it could break out above this to trade higher, perhaps towards the next target level around $310. Next slide. Then for Delta Electronics, this one surged a lot after a breakout of the downtrend channel. You can see that there was a sharp decline and a recovery. So now around as it closes the gap at around 100, close to 100, $108 to $118, we expect some sideways consolidation this month following the strong recovery. Yeah, so that's all from me. I'll hand over time to Paul to talk about Sheng Siong results. Thanks.
Thanks, Zin. So for Sheng Siong results, as the title suggests, the highlight of the results was just surge in new stores. Next slide. So for Sheng Siong in general, they're going to open like 8 stores this year. This is the highest since 2018. The results were generally in line with our forecasts. But the positive is again the acceleration in new stores, and they continue to increase the gross margins. If you notice the gross margins from 29.4 to 30.3. This is like a story that been I think the last 5-6 years they continue to raise gross margins, mainly because of fresh food contribution. I think fresh food contribution is of course much higher than 30%. So I think as they continue to sell more of this, then they can continue to see the creep up in gross margins. It's around the 40s, I think, for fresh food. The negative is the operating expense. This has been the trend since progressive wage was introduced. So under progressive wage, I think the cashiers and some of the cleaning and all those in the stores will have higher wages. I think around 8% higher. And because of that, then every staff in the store will have to have higher wages. So that's something that they are still trying to catch up with. So although most of the expansion in gross margins have been absorbed by higher wages, the last of the 3 years ended last year, so you still get the full effect this year. It is unknown whether the progressive wage model will continue because they are not sure themselves. So that is, I wouldn't say a negative, but that is something to monitor. So we did leave our revenue numbers a little because it's just trending a bit higher. Our target price, we actually increased it. They usually trade at 18 times PE historicals, but we just nudge it a bit higher because I think the growth rate is much better since they are on the fastest number of store expansion since 2018. Just as a side note, if you notice the revenue line, most of the growth is now from new stores. The SSS that you see, sorry, is a bit small, is 0.1. So what it means is that same store sales, I mean sales of mature stores isn't growing that much. So all the growth for Sheng Siong, I think this is nothing new, will all come from new stores. And the results on the left, you know, they went up 6%, and that's because the stores on a year-on-year basis is up by 10 stores. So last year was 70 this time of the year, and then now 77. So Sheng Siong has 6 more stores to roll out, so this will add another 9% expansion in the footprint. So this will at least add another 9% growth for the revenue, roughly, because not all the stores can have the same sales per square foot as the old stores. The one thing different from the expansion in 2018 of 10 stores and now is that of the 6 stores, I think 4 come from competitors. So competitors like Howmart, 10X, some of the names I do not know, I can't remember, like A-Smart, and also Giant, all returning stores. So the story for them is store expansion and also taking market share from the wet markets, of course, and also now from even competing retailers, which if they give up more stores, then they turn more and more subscale. And of course, the main challenge is wage inflation. So that one is holding back. Otherwise, the growth would have been much faster, maybe 2 or 3 percentage points faster if you just look at the gross profit growth. Next slide. I'll move on to our usual weekly. There was a kind of few news coming up from Singapore. Most of them show a bit of slowdown. So for the PMI, so PMI is like a survey of all the purchasing managers in Singapore. Not all, I mean, it's probably a sample. But what we do see is that there is a weakness. I think it's now 49.8. It is the weakest reading in 19 months. And not a year ago was 51. So there is a slowdown in orders for the manufacturing. I think no surprise. Loans growth in Singapore, that is the banking loans growth, it is slightly softer at 4.8, but it is still a very commendable growth. So of course, one of the overhangs that banks have is the worry that if the economy slow down, then loans will grow. But so far we don't see it. And just to give you a flavor, March of last year, loans was only 1.4%. So on paper, loans growth in Singapore is still growing, and just very small numbers, of course, but it's like 3 to 4 times faster than last year. So that will at least, I think, it will help offset some of the margin squeeze if interest rates come down further. The other negative news in Singapore was the RevPAR. So RevPAR is, think of it like revenue of the hotel. So this is your room rate, maybe $100 room rate, then your occupancy is 90, so RevPAR is $90. So it's to take account for occupancy and the room rate. So that is down 14, but yeah, we can't see this as a trend yet, because this is in part because of the Taylor Swift that we had it early of last year. But the rate is still the lowest in 15 months. So a bit of softness coming into the Singapore data points. We have some numbers from the US. I know some mentioned why the payrolls. So all these were before the tariffs. So hard to use a trend line for this. But it is above estimates. And the one in the background is that the government jobs are continue to slow down. So, I mean, so this is going to be one negative for jobs in the US. So we have to watch whether the other private sector will be impacted with the tariffs. We will discuss a bit later. Of course, there was core inflation, yeah, but retail relevance, because right now people are voting for the tariffs right now, and even the Fed also won't be taking much notice of this because there's a tariff coming in. The next slide. So in terms of our tactical views, the big gainer of, at least the big index gainer of last month was Hong Kong Land. So just a reminder that returning capital can generate alpha. I think we saw that in like Keppel and all that when they start to return more capital. So what happened was that Hong Kong Land, I think about 24th or 25th of April, they or last week, I guess, they sold one office in Hong Kong for 810 million. And they actually will deploy 20% of this into a 200 million share buyback. So this was all factored up by Hong Kong Land in October of last year. They had this huge capital recycling plan. So part of it is that their priority is to recycle, which is another word of selling assets. And they want to sell at least 4 to 6 billion of assets, including development properties. I mean, like like residential developments by end 2027. The market was, of course, this didn't know whether they can execute, and this time they can execute. So of course, why this new religion? Why now suddenly want to sell assets? Is because the long-term incentive plan for senior management is now on total shareholder return, which of course it should have been done that long time ago. But I mean now, it would how the senior management is compensated depends how the share price performs over the next 3 to 5 years. I guess this is another playbook for other property developers. I mean, if they want to sell assets, especially like CDL want to sell assets, then they have to at least give some targets. Then the market will at least be more comfortable with any monetization plans. So that's continuing with this theme. So we also see such recycling of assets and returning capital, or at least benefiting or narrowing the gap with the book value is also, we think, is happening also, like what was mentioned by Darren. First REIT has a tenant, CLI, is going to buy back almost all their assets. And it's pretty obvious they're going to do it soon. I mean, because they are preparing a 1.1 billion facility. They're gearing up to actually do this buyback. So why the difference is that CLI has been taken over by private equity, so they don't want to keep paying the rent, they want to buy this back. Another REIT which we think will also enjoy this so-called alpha or share price improvement is like what Miao mentioned, Elite. So they're also going to sell another major assets which is earmarked for data centers. So that should also be higher, which is around 8% of the assets. And it also should be, I don't know, maybe 40-50% premium to book, because this is now a data center with power allocated. And both are, in the meantime, as you wait for this, both are already paying a 9% dividend yield, and they are trading below book, some 15%, some 20-30%. So we had some questions on, so when will the slowdown happen? So firstly, in terms of the trade relations, there is a bit of thawing between the trade war between the US and China. Both has even a trade hawk like Steve Miran, which is the economic advisor to Trump, has also mentioned that maybe they need to dial back a bit with their relations with China. But anyway, if you watch the LA port has been going around the media telling everyone what is happening on the ground now. So just to give you a flavor, they see volumes coming down 35%, at least in early May. This is year on year, so this is not month on month. So volume is going to collapse. Of course, there are several reasons why it's collapsed. So basically, all the importers, all the retailers, can be a Walmart, are not importing because from China, especially because, as you all know, the tariffs are high. And even if they want to import, they're not sure what if they import now and then the tariffs suddenly get removed. So another reason not to import. And even if they do import with the high tariffs, they're also not sure if they can pass it on to the consumers. So basically, all the retailers, importers in the US are just pausing and they're not doing anything. In terms of how this will impact, I think May can still hold. I think May retail sales can still hold because according to the port, most of the retailers have 6 weeks. So they can hold, that means they have enough inventory in the stores for at least 1.5 months. So you won't feel all these shortages, maybe weakness in retail, even up to May, but probably June if this thing continues. The problem for them, they worry is going to hurt summer sales, back to school sales, which I think is July, and also the Christmas sales, because factories in China receive the orders usually in May. Of course, the thing is, if this thing continues until May, April, then Christmas season could also be impacted. So usually you need to order from the factories 3 months in advance, then another 2 weeks of delivery. So by now they normally order, because they order May, then June, and July, probably August or whatever, then the thing starts delivery. So the longer this holds, then Christmas could also be impacted. Again, this is just the trajectory, doesn't mean it's 100%, but just to give you a flavor. In terms of events for this week, the big one, of course, the Federal Reserve Fed rate decision. Of course, we're not expecting any rate cut, but the more important one this week will be all the 3 banks will be reporting results. So this will really give you the direction of the Singapore market. But again, I think like what Glenn mentioned, we are still positive on the banks. Some of the corporate insights, I think this for everyone, CNMC, Takraw. Some might not been uploaded yet in Poems, but again, this is open for anyone. Anyone can just dial in. Next slide. This is just a reading. So the problem now we have in Singapore is that the collapse in new orders. So this is a bit of a lead indicator because it will tell us, the purchasing manager, compared to last month, how is the orders. But again, last month was exceptionally strong, I guess, because everyone is front loading the orders ahead of tariffs. Loans growth, although it might be a bit slower, but it is still trending upwards. So that's the positive for Singapore bank loans. Next slide. Then then we had a Wilma briefing for analysts. So let me just give you some highlights. The results was generally up mid-single digit, 4%. The main questioning was around the impact of tariffs. So just to give you some sense, China imports a lot of soya beans from China. But right now, because of the high import tariffs, nobody's going to import from the US. But what Wilma says is that there's enough in South America. So South America produces 230, China import 100, so more than enough. In terms of palm oil going to US, only 2% of their, so it's hardly anything goes to the US. But the one thing is that Wilma's model has always been the ability to time. They call it timely purchases. Basically, they can trade because they got better information of demand supply. But with Trump changing policies every other day, I guess it becomes very hard for them to trade. So this might impact the margins. Then of course there's also this thing of Trump making a final decision on the direction of biofuels. Of course, some say he wants to cut back biofuels. That means it will hurt soybean demand and affect agri prices. At the same time, he's worried to impact the farmers. So it's not very clear, but there's something to watch. For palm oil, I think they are a bit bearish, my own view. I think based on what they said, they didn't outright say it, but I think they said that because of the weak crude oil price and global economy, should be happy that palm oil price is stable. Cross margin is a bit better. The China consumer volumes are still there, but just that they might be trading down because of the weaker economy. The big worry, the big overhang on the share price now is on the Indonesian government. So the Indonesian government is taking back you can see all over the news, they're taking back a lot of land from plantation companies which they deem as illegal. So Wilma said that they probably got 2,000 to 3,000 hectares affected, but they're not sure whether it's going to be a fine, they're going to be confiscation because there's no clarity. So for me, at least, we think the outlook for Wilma share price will be sluggish. Like we mentioned, the agri prices will stay soft because of the economy, and then and this will hurt agri prices. Of course, the ability to trade and get that extra margin in their trading activity is going to be impacted because if they can't read the market that well because of the Trump factor. And the fourth is, of course, like I mentioned, uncertainty and biofuels. And the fourth one will be, of course, Indonesian policies. We're not sure how is it impacting them, or whether they'll be fined, whether land will be taken back. But the problem is that you take back the land, then who's going to run it? So most probably they're going to be at fine. I mean, that's my own view. Next slide. Move on to our monthly. So we have a usual strategy monthly. I'll just give you some strategy highlights. So we still think the economy is going to pull back. What we do see is the Atlanta Fed. I didn't give you all the charts, I don't have too many, but you can read it from our report. So the Atlanta Fed, which is a bit of a lead in GDP in the US, is also contracting in the second quarter. And we also see financial conditions tightening because the credit spread in the US and globally all tightening. Because credit spread means your double B bonds versus the US Treasuries. Again, we are still thinking of 3 to 4 cuts the market's pricing. Singapore remains a safe haven, so the US bond yields compared to Singapore, that means is at the highest since the global financial crisis. So when during crisis, investors tend to flock into the bond yields, but I think they are probably pulling back and then repricing the US bonds as a safe haven, and then just parking it elsewhere like Switzerland and maybe even Singapore. So that's why bond yields, that means the interest rate in Singapore is much lower than the US. One way to try to understand it. Which usually isn't the case. Everyone usually run to the US. Valuations is still attractive. I mean, 12 times against our average of 14, and we got a yield of 5.6. So the sectors we favor is all these, the usual thing like construction, defense, finance, property REITs, which is the foreign REITs. We still prefer foreign REITs, and then power and telcos. Next slide. Okay, this is our model portfolio. We were down 3, and then the market down 3.5. What hurt us, you see the middle here is the banks. But again, this is because it has gone come dividend. So of course there'll be a bit, as usual, every month, every May, April, it'll always be weak because it's come dividend. But of course, SATS is the one taking the brunt of the trade war. We didn't take it out because we just think that we're just hedging our position. Just in case this trade war thing thaw, then things recover because it's so volatile. That's why we left it there. I mean, we all obviously clear that SATS is going to be impacted, but we just left it in there. And Propnex also impacted because they got special dividends, so this also come dividend impact. Next slide. Okay, this is just for illustration. I mean, we segment out the Singapore market into all these few segments. The one that did well was telcos, then property, mainly because of Hong Kong land, and conglomerates did well, because Sembcorp Industries. What you see on the data on the right hand side is just some of the small mid caps and total shares are not top gainers, and so of course the big gainers have been some of the gold stock, Alltech, Singtel. Losers were on the right here. A lot of some of the tech names got hit badly. At the bottom here are more the index gainers. So what did well has been Hong Kong Land, Singtel, ST Engineering, SGX. The worst ones were Mapletree Logistics, mainly because of the China exposure, and Citrum and all the banks and SATS and all that. Yeah, commodity related. I mean, a bit strange. Yeah. Next slide. So in terms of asset classes, just to give you a sense, Singapore actually, although on paper Singapore is down 3.5, but because of the US dollar, we're only down -1. US actually was up. So and then the gold was actually up 5.4%. So there's a strange thing. A safe haven commodities did well, but the growth, that means commodities tied to the economy actually went down. And I forgot to mention, the reason why our monthly is called Brace is because actually the US market is actually back to the 2nd April when the tariffs were announced. And so the US market is like trading like the tariffs don't matter. So that's why we are a bit concerned because it's like next slide. So this is just by local currency, by the various Asian stocks. So Singapore banks were one of the worst hit. Vietnam, of course, because of the tariff worry, then Indonesia and ASEAN all recovered. Again, this is just for your reference. Next slide. Okay, yeah, thanks everyone. I think we move to the
Yeah, maybe let me
Darren.
just start first lah, since I think there's a question on the banks and also on I think on iFast as well. Okay, let me just start with the banks. I think Paul already mentioned most of it. Yeah, but we are still quite positive on the banks. For the first quarter results, I would expect that we wouldn't see really great we won't see like double-digit kind of growth like what we saw in 2024, right? That was 2024, it was mainly due to the fee income recovery, which is why we saw this huge, rebound in their bottom line, in their earnings. But for first quarter 2025, I think we are all quite a bit more cautious, but we are quite optimistic as well, because firstly, loans growth has been relatively healthy. Right? It's still at that mid-single digit level. It did dip slightly, from 5+ to about down below 5, but it's still hovering around that 4 and high 4 mid-single digit level. So that's quite healthy. For fee income, I think we will see it, come down slightly, from the levels we've seen in 2024, as in terms of growth, year-on-year growth. So we won't see that, 30-20% kind of growth. But I think we'll still be able to achieve, the banks will still be able to achieve double-digit growth. So, but low double-digit, maybe 10 to 15 kind of percent range. But I think the one that we will keep our eyes on, more importantly, the two things, firstly will be the net interest margins. Margins will, I think, our expectations is that margins will maintain stable or even, improve slightly. And this is really due to two factors. Firstly, the steepening yield curve. So the banks are able to put it into more longer term kind of like bonds and treasuries, where they get better interest rates for longer term. And they are able to then protect their net interest margins. And then secondly, also we are seeing this inflow of CASA. So this is CASA, stands for current account, savings accounts. And this is very important for the banks, because this represents the lowest cost of funds, kind of lowest cost for their funds, for funding, right? CASA is like, I say this multiple times, but it's a bit like your DBS multiplier, UOB, one account, OCBC 360 account. So all these banks, they have these CASA accounts, and the base rate is so low. It's almost as if it's like free kind of funds for them. Right? I think it's 0.05%. So that's where they get majority of their funding from. And we are seeing this currently, there's this inflow because a lot of the fixed deposits that, maybe yourselves or even me and myself have put in 1 year or 2 years ago, they're starting to expire, and now when we look into the market, we only get like 2%, right? 2+% kind of rates, and it's dropping even faster now. So it doesn't make sense for us to, put it back into fixed deposit. Hence, it just flows directly back into the CASA. So that's where the money is all being held. And this is beneficial because the bank's funding costs will go down. So on top of, the funding costs lowering and the longer term rates are increasing, right? We believe that the net interest margins will not just, bottom line is that they hold stable, but of course, on the more positive side is that it might even inch up slightly. Right? And the loans growth figures are also quite positive for at least the first quarter. But then this is for the first quarter. Moving on into the rest of the year, there is definitely a chance that it will go down below that mid-single digit mark. So that's why I think Paul also mentioned that the guidance that they provide on where they are seeing it, because they have their own April figures, right? Post tariffs and post Liberation Day, where we can see, if they are guiding, how they are guiding the banks, their loans growth will be. I think that will really point us, into a direction of how we can, better estimate loans growth will be. Yeah, and the last one is that, the provisioning wise, it's quite stable. I believe, that the management overlay that the banks have, mainly due to, COVID sort of giving them a wake-up call, right? Where they finally realize that, oh, okay, maybe we don't have enough set aside in case something happens. So they learn from that, and now they've set aside huge sums of management overlay. DBS is really the only one that mentions how much they have. They have around $2 billion worth of management overlay. Why is this important? Is because that if, let's say, the general provisions or provisioning comes in too high, they can offset some of that, by releasing the general provisions and then write back the called general provisions right back, and or specific provisions come into high. So that will sort of balance it out for them, and that's where they can maintain their credit costs as to what they have guided. Yeah, so that's why I think all these factors, and also of course, the high dividend yield that they are giving, is why we are still quite positive on the banks. Okay, on the last, I think the iFast one, I think it's asking for some clarity on what is this Hong Kong e-pension business all about. Yeah, so this, basically you think of this Hong Kong, they call it EMPF. It's basically like our CPF, right? So it's not voluntary. It's not voluntary. It's really it's compulsory for a lot of for I think majority of the Hong Kongers. So they will have to contribute, right? And there's this platform, like in Singapore, it's managed by our government bodies, but in Hong Kong, the companies will bid to manage the platform, right? So iFast won the bid, so they are managing the platform. They are not managing the money just to be clear, they're not managing the funds. They are managing the platform, so they will get a bit of like I think they get platform fees when more. So as each client comes in, they get a platform fee for each client. Right? They don't disclose how much they get, but I think the best guess is I think it's a small percentage, maybe 0.5% to one. I think around 0.5% for each. That's my best guess for each client that they come. So that's how they make the money. If more clients are onboarded, then they will get basically more fees, right? And what's happened recently is that I think the clients that came in, I'm not sure why, but maybe they couldn't handle the volumes, and maybe they didn't have enough staff, or it's because the main issue they said was the manpower issue. So they probably did not have enough staff to handle the volumes. Maybe the process was a bit more elaborate than they previously thought. Hence, that's why they had to have more manpower and they had to hire more people, which really just cut out the bottom line. And that's why you saw earnings for the Hong Kong sector drop by 7% in the first quarter, and then now they are forecasting and guiding that it will drop by the profits will drop by 12%, mainly due to these higher expenses. So it's not that the top line or less people are going on the platform. It's really just that they have to hire more people and to spend more in order to make sure that it goes smoothly. And they definitely want to make this go smoothly, because it's, after all, if you think about CPF, right, it's very important to the Hong Kongers in terms of their pension, and this is all their savings. So if the platform is not smooth, then I think there will be quite a bit of issues with iFast. So I think that's the whole EMPF thing explained. They also have another one, it's called Also, where it's voluntary and they will handle the funds, but this is quite a small portion. The majority of the Hong Kong sector of the segment really comes from this Hong Kong EMPF or e-pension. The Also one is voluntary and they will handle the funds for the clients, but I think it only makes around 10 to 20% of their Hong Kong business, so it's still quite small. Yeah. So I hope that clarifies, gives you a better understanding of how this Hong Kong e-pension business really works for iFast and why it's so important. I think as of first quarter, it makes up about 50% of their bottom line, the Hong Kong sector. That's why the reaction was so big by the investors and shareholders, and then we saw the share price collapse. Yeah. I think that's all for me. Let me hand it over to the rest of my colleagues. Thanks.
Yep, thanks, Glenn. Yeah, so maybe I can move to the class slide. There's a question, why class was downgraded to accumulate despite no negatives as shown on the slide. Yeah, so actually I think you're referring to more of the FCT slide. Class is still a buy. So yeah, class is still a buy. As you see here, the downgrade to accumulate is more of the FCT. So like I mentioned during the presentation, FCT is sorry, but I can move to the FCT slide. SCT is downgraded, yeah, mainly, yeah, thanks. SCT is downgraded mainly because of the share price movement. As you know, recently over the past month, it was up about 10%. So as a result of the share price movement, that is why our accumulate we downgrade to accumulate. So basically, buy is a 20%, more than 20% upside. Accumulate is between 5 and 20% upside from the most recent share price. So that is why it's been downgraded. But other than that, no change to target price and yeah, no change. Yeah, thanks, Mel. I think I can go back to the last one. Yeah, CLI last week announced the issue of the 0.0311 CICT units for every share in the announcement to allow round up of fraction CICT to hundreds. Yeah, so there's no announcement. So if you want to trade the CICT shares that you got from the dividend in specie, you have to trade, unfortunately, to trade in the unit market or the odd lot market. Yeah, there is no announcement that they will allow you to round up to the 100 lot. Yeah. So if you want to sell, you have to do it the odd lot market. Stoneweg stapling of a new business trust. How will it impact shareholders' value and what benefits can shareholders expect? What effect will it will have on the dividend policy? Yeah, so there will be no effect on dividend policy. Everything remains the same. It will also not impact shareholders' values. In that there'll be no negatives. It's more of a positive thing. So they structure this they staple this business trust to the REIT. It basically will enhance tax efficiency and will also provide future strategic flexibility by doing so. So for instance, under the REIT structure, these are just some examples. Under the REIT structure, like because they install solar panels on some of their properties, if they want to sell that back to the grid, yeah, you basically under REIT structure is gray. But most of the time you're not supposed to trade electricity, but under the BT structure you can do so. And also there are some tax structures that they can benefit from, and also for REIT, basically they have the 10% development cap. Yeah, and they can tap on their sponsors development pipeline for the data center. So by having this new structure, will basically is a preemptive measure for them to plan for the future acquisitions. Yeah, so basically it's a positive and not no negatives for that. Would incoming tourist numbers to Singapore expected to drop going forward? If yes, which segment of the hotel REITs would weather this better? Would FEHT better than Class FEHT as it focus on SG mid-tier? Yeah, so actually both Class and FEHT also focus on mid-tier segment, but if you're comparing just like for like, FEHT, their assets are now all in Singapore. Yeah, pending the Japan acquisition. But for Class is more more geographically diversified. So like the weakness in Singapore, like I mentioned during the presentation, can be offset by the very strong Japan market. So Singapore accounts for about 15% of the AUM. Yeah, so going forward, we expect the tourism numbers year on year to actually be slightly higher than last year, but still maybe about 5% or lesser short than pre-COVID numbers. So that is for international tourist numbers that we expect going forward. And yeah, because there's also a down trading trend. So basically the mid-tier hospitals will benefit more. So yeah, FEHT and Class both also will benefit. But FEHT is just a pure play SG REIT for now. Yeah. ESR REIT, it trades around 9%, seems to be unloved and undercovered by analysts. What's Phillip's view? Yeah, so we don't cover ESR REIT, but basically they have done their portfolio reconstitution and they made some divestment acquisitions and they benefited from that. We saw their first quarter performance is had a DPU increase of 7%. Rental reversions are starting to slow also in line with other logistics assets in Singapore, the incoming supply. Yeah, but generally, yeah, we don't cover. So yeah, we don't exactly have a target price for that. Yeah, perhaps I can leave that to Zane to do some TA. Yeah, if not, yeah, apologies for that. Yeah, CLI painted a very optimistic investment in China that will contribute in the future, or do you concur with them or skeptical on this? Yeah, so CLI, they're trying to divest their on-balance sheet assets in China, and they're looking to invest in more of the funds or in China rather than having these assets on the balance sheet. Yeah, so basically, like in the first half, or rather in the first quarter this year, they raised almost 1 billion, so that included a 5 billion RMB mandate, which invests in China, core strategies in China, and also they are looking at to list the first China C-REIT, CLCR, with 2 seed assets. So they're looking to expand their FUM and increase more of the fee-related business. So yeah, that is more of the raising funds in China, tapping on Chinese domestic market, and selling down of the balance sheet assets that they hold on the China, or even perhaps they can seed some of these balance sheet assets into some of the funds that they'll seed that they'll raise. Yeah. So it's more of a moving into investments in funds in China rather than having the balance sheet stake in these Chinese assets. Yeah, I'll hand over to my colleagues for now. Thanks.
I'll
Yeah,
take
thanks. Oh, sorry, go ahead. Yeah.
Thanks. Yeah, I'll take the SET's question. So the upcoming result will be FY25 result. Yeah, so full year FY25 result. Yeah, so we're still optimistic, mainly because cargo revenue is still expected to be fueled by a very strong e-commerce demand in North America and Europe. And for the next quarter, which is first quarter 26 result, we do expect like some front loading to benefit their cargo delivery. Yeah, but from second quarter 25 onwards, we are pricing in decline in cargo revenue. And so cargo revenue is 50% of the overall revenue, and North America accounts for 50% of the cargo revenue. So the total effect will be like around 25% for its top line. Yeah, so yeah, we do expect like a mid-single digit impact from the US tariff. Yeah, but to answer your question, we're still optimistic for the full year 25 results. Yeah, I'll hand over to Paul. Thank you.
Yeah, thanks, Miao. Let me just try to take some questions. Which blue chip mid caps can benefit post election? Oh yeah, someone asked us last week to take a look at the questions. Yeah, sorry, we still haven't figured out how to do that. Which blue chip mid cap stocks can benefit? I don't think there's really any beneficiary, because unless you got some really drastic change in the results. But at the margin, maybe it at the very margin, then maybe just people can at least sign a relief, because then the government policies, especially for the construction sector, building materials, will continue. There's no change in policies. So I don't see got any beneficiaries. Just that probably there is no change in policies as well, which I don't think everyone expected anything and otherwise. I mean, just my own view. Yeah. We did do some checks on the results of post-election, any impact on the market. It is really no impact. It's always just follow the underlying market in the US rather than anything. When we did our last time, when we did a check, so I don't think, maybe just a sign of relief that this, I guess the government policies will remain, especially for construction sector. Why the US job market still so strong? Will we see a slowdown in second quarter? My guess is any slowdown in numbers will only come in slowly, creep up in in June. I think most of the commentary, if you believe in if you assume the commentary is that most corporates in the US are freezing headcount, not doing anything, not spending capex because they're not clear on the policies, then we could probably see it from June onwards, especially in the manufacturing side and the retail part. So that is the where we see that would be probably the weakness will start to come. Your take on Venus outlook for GE, and is oil tech too expensive now? Like the Venus, again, really no Venus, I guess. If there's a winner, I mean, it's really relative, because I guess construction is the big beneficiary of the government pump priming. Then since it's status quo, then I guess they could be the winner. Yeah, but again, no one sold because they were thinking there will be any drastic change. So oil tech, probably the share price now is probably like 22 times PE. My guess is the market is running because they're going to do there's going to be a bonus issue coming up on the 9th. The X date is on the 9th of May. Although in theory bonus don't really work, but I think in reality people just do chase after the bonus and it tends to outperform. Yeah, especially if you look at the prop next, what happened. So for me, then it will be depend on the news flow. We're not changing our numbers yet, but I think their results, they will give an update soon, and then if they do announce a few more projects, then that could carry. But the big ramp, I mean the big upside will still come from the Pertamina contract, which there's no news yet, but maybe it could take another 1 or 2 more months before that happens. So in the meantime, we're still confident that they're going to announce some contracts, especially from the overseas market and also some in Malaysia. That's our own view. Yeah. Any more upside for all tech? Capital infrastructure is on the low side, but pay good dividend can accumulate. Okay, and for all tech, yeah, we mentioned probably they could run, especially after the bonus. Then after that, we depend on the results, which we think will still be strong, and also we still think they can maybe announce a few more contracts. That's our own assumption. Capital infrastructure, yeah, capital infrastructure was a really tough thing to analyze, like we highlighted before. They have a wind farm in Norway, then solar in Germany, waste management in Singapore, power in Singapore, then then some buses in Australia. Yeah, then they want to do submarine cable fixing, laying of submarine cable. Frankly, I'm not very sure how to analyze this company. Yeah, but the only thing is that the gearing is rising, the interest expense is rising, and from what I understand is that after expiry, they are actually becoming more and more operational. I think some of the assets have been given back to them from like a master lease, just a landlord to operating, and then I think that's giving them a bit of an issue. So I'm not a big fan of capital infrastructure because it's very complicated. I'm really not sure what's going on, like so many countries. So that's why we never have a very strong view. And yeah, and yeah. So it's not like a REIT, no. A REIT, at least I'm pretty more confident that the property values, are continue to rise. But this one, really no idea. Yeah. Yeah, sorry, I'm not really helpful. Yeah. Okay. Hi. Any comments on the future of Sembcorp and Keppel? So for us, I think Sembcorp is viewed as a defensive. So I think we've seen Singtel and Sembcorp industries perform well because they are viewed as a very defensive sector. I mean, economic slow, so especially power demand will still be strong. But my preference is still Keppel because I think Keppel, I think like we highlighted last week, we do get a better visibility of growth from Keppel. I think they have a few projects that's going to turn on, and that will give them the earnings growth. The Keppel South completion, the property. Then you also have the submarine cable that's completing second half of this year, so that will give a big kick in earnings. And then the Keppel Merlimau power plant will complete in 2026. Sembcorp's new power plant in Singapore will only be in 2027. And at the background, there's always possibility of Keppel selling M1 and also maybe selling some of the REIT assets. So at least there is that operational growth and there is the monetization of the capital recycling kind of angle. So that's generally my view. That's why we prefer Keppel. Comparison high. Is the high point is the comparable for Sheng Siong DFI retail? If yes, which of the two offer better price upside? Yeah, I don't really think it's of course they are the same in a way. DFI has retail in Hong Kong. They also have 7-Eleven in China. They also have IKEA. So in terms of retail, yeah, they are a comparable DFI, but geographically, no lah. I think for Sheng Siong, for me, I'm more comfortable with Sheng Siong because we have there's more stability in Sheng Siong. At least I know there is a structural trend of them growing market share, more stores. For DFI, it's just the whole weakness in retail, especially in Hong Kong. I think in Hong Kong, I think we all know. I mean, it's very obvious. I think a lot of people are going to China. Yeah, but so that's why. Of course, it can be obviously wrong too. I mean, this is also starting to change. But but what we're saying is that the macro situation in Hong Kong, China is a bit weaker than Sheng Siong, but they are comparable in the sense that they're exposed to retail. But I mean, the real comparable or competitor for Sheng Siong is NTUC FairPrice here. Yeah, hope that helps. Yeah. SGX is big against US dollar. Actually, the SGX actually is quite strengthened a lot against the US dollar recently. My own view is that I think the US dollar can bounce. I think, but no, of course, it's a very contrarian view, but I think it can bounce because if we do get a big slowdown, I think US bond yields can start to creep down again. Then I think the market will turn back to the US as a safe haven. I mean, that's my own view because there's really no alternative for US dollar. I think right now what we do see is a bit of the maybe repricing, a bit of a withdrawal of flows in the US after all the crazy kind of policies coming out from the US. But you can't really unseat the US. I think even if Russia and China trade, they probably use US dollar too. Yeah, no, probably they don't both trust each other's currency. So for me, I think US dollar will probably rebound, but I think you need to just get a bit more stability from Trump, which is, I guess, the hardest thing to do. But I still think the US is still the safe haven. Again, but you probably might see this only in the later part of the year when the US economy is slower, when the Fed start to cut rates, which then the market might just view that as the safe haven. Again, that's my own thoughts. Any thoughts on Nam Chong? Yeah, Singapore. Nam Chong, you got to ask. I think Myanmar went for Nam Chong. Yeah, in view of the slowing. Paul, your views on sell in May? Any signs that I don't really believe in all this sell in May. Probably wrong too. But it's like believe the like we always joke the movement of the moon affects the selling. So I don't think the planetary movements affect the selling. So seasonal sell in May, any signs that it may happen arising from tariffs by Trump or other issues? Yeah. We don't think that will happen. I think every month has its own individual. I'll probably get Zane to show you this. Yeah, I think Bloomberg does a very good job. They show you the monthly performance, every January, February, March, and all that. Probably we can do that to show everyone like a heat map. If it's positive, it's green, then you can see for yourself. I saw the US. There's no correlation. I mean, sell in May. Yeah. Paul, Mr. Pat, can you explain what is LTIP of TSR over 3 to 5 years relating to Hong Kong land? Yeah. So LTIP means the long-term incentive plan for the senior management, and that is based on total shareholder return over 3 to 5 years. So total shareholder return is just another way of saying share price performance plus dividends over the share price. It is also on the absolute and on the relative space. I do not know the weightage. I mean, maybe how they weigh absolute, how much is relative. But that is what it means. I think this could be the first time ever Hong Kong did it. I'm not sure, but in the annual report, they said this is the first time. So that they are benchmarking, CEO pay, CFO pay, all the management to share price, which is, I mean, Should have been done earlier, but anyway. Hi Paul, can you explain why you favor foreign REITs over local REITs? Yeah, I think there's a few questions. What we mean by that is that we see the yield is better, but I can understand a lot of Singapore investors don't like foreign yield REITs, especially what happened to Manulife. But we see the yield at almost 9%, 8% for Stoneweg, for Elite, for First REIT. Just that I think local investors view overseas REITs with a higher risk, but I think you get hit already. I think everyone has seen Mapletree Logistics. So a lot of Singapore REITs also have a hidden problematic foreign exposure, especially those that have Australia, Melbourne office assets, Chinese office assets. I think we saw this. So it doesn't mean buying a Singapore REIT is actually safe. I mean, that's our point. So we just think that just assess the foreign REITs on its own. And with some of these big asset sales coming up for some of the like we mentioned, Elite and First REIT. So I don't think it's going to re-rate them, but I think with the 9% yield, we just find that they are more attractive. And the countries like Australia, UK, and even Europe they're probably going to cut interest rates very aggressively. So they're also going to get the benefit. And they've already started cutting, unlike the US market, which Singapore is probably more linked to the US monetary policy cycle. So that's what I mean. The macro and it seems to be better, and you got this the yield is better. And there's also this event type of triggers for foreign REITs. That's where we are coming from. But I know most people won't agree, because when you buy REIT for safety, so you rather buy Singapore, which is understandable. I mean, but this is just our own preference. Why you prefer REIT and S-REITs? Just have to be careful. Not all S-REITs, a lot of S-REITs also have exposure overseas. Right, like I think like Mint and then all I thought you thought you bought a safe data center in the US, but then suddenly they started to exit our data center. I mean the tenants. Why do you favor REIT foreign mentioned in your main strategy? Thanks for the question. Sorry if it's a bit confusing for capital infrastructure. Any comments or its outlook? You're not a big fan. Do not know how to analyze this one. STE, what's the expectation for coming results? The results will be coming out on Friday. I think for the first quarter, they usually don't give earnings. They probably just give turnover. We still think it'll be strong. The weakness on aviation will only come in the second half. So there's probably still some momentum. Although we mentioned, we took it off because we saw it pretty expensive, like I think like 30 times PE. But I think probably there's still some momentum, but we just think it's expensive. So that's why we took it out from our model portfolio. And we still think the results should be strong, because the impact of the aviation you're not going to see it until the second half. Because for ST engineering, just to remind everyone, there are few parts of the business. There's defense. You guys use like 1/3 is defense, and 1/3 is the airlines, which is maintenance of aircraft, and building of engines for the A320, the small engine planes. I mean the single aisle planes. And another part of the business, not 1/3, but another part of the business is more the traffic business that they do, like ERP system, which they bought, TransCore, and satellite. So just a way to understand ST engineering for those who don't know, because it's a bit complicated. Foreign risk recommended. Can you comment on the exchange risk and the effect of this? Yes, you will take some FX risk. That's for sure. But we think it's compensated by the yield of almost 9%. And for Indonesia, which is of course the highest risk one, they like I think what Darren mentioned, they have an inbuilt escalation. I think it's 4%, if I'm not mistaken. Correct me if I'm wrong, but there's probably like a 4%, where they assume the rupiah will weaken 4%, or I think 2 or 4%. I forgot the number, but they are assuming FX. So there's a 4%. Thanks, Darren. So there's a 4.5 inbuilt yearly escalation to compensate for the weakness in rupiah. Because I think the rupiah is the one that everyone's probably the most concerned about. Okay, thanks. I think we probably go to technicals. I think we addressed most. Thanks everyone for your questions. We'll move on to Zane. Thank you everyone.
Thanks for moving to the technicals. So first question is on CLI. So for CLI, I think overall should be quite range bound for now. Despite the bit of a sell-off a bit of a sell down last Friday, but still holding support at 252. So probably we could see some rebound towards 263, 265 will hold as resistance. So yeah, probably is quite sideways, I think, in the short term. And next for AEM. AEM, I think we're likely to still see some weakness. I think it's a bit of a rebound, but above 123 is still quite a strong resistance, I think, from it was a previous support level, as well as perhaps a bit of a downwards resistance, I think, right? So perhaps just some range bound consolidation between 150 to 123 right now, for AEM. And then for Frasers Hospitality Trust, I think overall it's still just short-term momentum still remains quite good. I think around 66 cents for now. So I think we could still see the trend continue up. Yeah, some support around 65 cents for now. Then maybe a bit of a consolidation, then it could head up higher if it does break above the 67 cents level. Okay, next one is SETS. Okay, SETS, I think a bit of better price action recently. Trying to break out of this downwards resistance line, also above the 280 level after a bit of a consolidation. So I think in terms of short-term momentum, I think we could see some slight further bounce, perhaps towards close to 297. There could be some resistance next. Okay, then for Centrepoint Industry, I think overall still quite strong. Above this 643, 644 level. So I think we could still see the trend higher. In terms of resistance, would come from this uptrend channel here. Closer to about 680, that will be a key resistance for Centrepoint Industries. Then there's a question on STI. STI, I think quite flat for now. So I think quite expected because around the 3,800 area previously, this was a strong support. And overall, it's just doing a bit of consolidation over here for the time being. So I think we might still see this consolidation continue for a while. And next up is Samudra Shipping. I think a bit of a rebound towards this resistance around 88 cents, but over here I think for now it's still hold with resistance, but support probably 84 cents for now. So maybe some sideways consolidation. Yeah, since previously this was like a range area, so between 84 cents to 88 cents for Samudra Shipping. Okay, then there's a question on the currencies. First up, US dollar. I think US dollar still rather weak despite the rebound in the US market. So I think for now, the key level need to try to break is above this 100. It is the dollar index, so we need to try to break above 100 psychological level as well. Currently, we're trading within this downtrend channel. So overall, it will still be weak unless it try to break above this 100 level over here. And for now, just still sideways. So I think still we could still see some weakness unless it breaks above this key 100 resistance. Okay, the next one, Singapore, I think overall still holding up quite well, just a bit of a sideways, still some resistance at 380, but overall uptrend is still holding pretty well. So I think as long as you can try to hold this recent range support at 370, then I think should be still okay. Next resistance levels upwards, will be 386 and 392. Okay, then next one is Food Empire and CNMC Gold Mine. So for Food Empire is still pretty strong, but I think we could see maybe a bit of some consolidation for now. Yeah, after this spike towards 147, a bit of a slight pullback taking place. Yeah, so I think a good support probably 133, 134, this swing high level. And some resistance at around 144 and above right now. So maybe just a bit of a consolidation for now. Okay, CNMC gold mine also pulling back with the gold price pulling back. Some support around 40.5 cents for now. A bit of a just sideways taking place, but I think the next good support, which should be quite a good support, I think could be closer to 38 cents, which was this swing high over here, as well as a retest of this trend line breakout previously. Okay, then next one is on Netlink Trust. Netlink, I think overall not discounted nothing much. Just probably a bit of consolidation, perhaps between about 90 cents to 92 cents for the time being, I feel. Oiltech very strong. It's quite yeah. So Oiltech still managed to break above this 135 level. I think overall still very strong momentum as long as it stays above this 5-day MA, which is like 140 now, and forming higher highs and higher lows every day. So unless it breaks below the previous day low, then I think overall the momentum could be still sustained. For next up, Yangzijiang Shipbuilding. For now today I think today is XT, that's why there's a gap down. Maybe a bit of it could retest maybe at 208. Previously this was a bit of resistance at the range. Then it might just go a bit sideways afterwards with some resistance for now above like 217, 28 to 220. For Yangzijiang Financial Holding, I think it's just moving a bit sideways as well. So for now, I think support still hold maybe 69 cents, which was like a breakout level as well as 10 MA level. Then resistance still holding at a key level at around 73 cents, which was a previous range breakdown level. So just sideways between 69 cents to 73 cents. Next one is, there's a question on, is there any bottoming in sight for the USD SGD pair? Also, what's your view on Sing dollar to ringgit? Yeah, so for USD to Sing dollar, I think it's continue to see some weakness. So I think we could see maybe perhaps it try to touch this swing low at 1.28. Then maybe we see a bit of rebound afterwards. Yeah, overall very range. So this was a key level previously in September last year. So I think if it does touch it, then we might see the US dollar bounce back a bit afterwards. Then for Sing dollar to ringgit, I think recently the exchange rate has been going down. So currently, especially in the past week, from like 3.34 and now it's around 3.25 at these levels. So you might hold a bit of a bounce for here, but I think overall the trend downwards might still continue. Maybe towards like 3.2. Yeah, overall, the longer term trend is like after the previously when it broke below like 3.45, it's coming down as well recently. So perhaps this could just be a very big range consolidation right now between 3.2 to 3.34. So it might, I think it might still continue a bit of weakness in the midterm. Then what's my view on gold price in terms of TA? I think it's doing a bit of a pullback for now from a bit of exuberance previously. In terms of moving averages, currently below the 5 and 10 MA. Previously there was a bit of consolidation around 3,200, then broke below that. So I think we could still see some weakness, some short-term weakness, maybe perhaps towards 3140, 3150. There could be some good support from this previous swing high level. Yeah, on the weekly itself also, I think could do a retest of the 10 MA, which is around 3140 about there. So could see some further pullback. Okay, then there's a question on Alliance Bank. So for Alliance Bank, I think doing a bit of rebound recently, but I think it could be quite short-lived. Maybe 4.6 would be a resistance from this previous consolidation. Yeah, on the weekly chart itself, This is around the 10 MA level as well. So overall, there was a breakdown previously from the uptrend. So this could just be a bit of a short-term bounce before it turns down a bit again. Next one, FCT. So Frasers Centrepoint Trust. Frasers Centrepoint, I think, still quite resilient. Still testing the 228 resistance again. This upwards move is still quite nice, moving nicely. Last week holding a higher low at 224. So I think overall there could still be some chance of an upside if it can break over this 228. Next resistance maybe perhaps at around 232. Yeah, for FCT. Then there's a question on Centrum. I'll talk about the TA portion. So for Centrum, I think it's trying to inch up slowly. So after clearing resistance at around 188, 189, managed to hold a bit of a sideways over here. So as long as can hold this 190 level, maybe we could try to do a bit of a sideways at 199 to about $2 and $2.04, $2.05 over there. So short term wise could be still on a bit of a up for now. Yeah, so I think that's all for the TA portion. I'll hand over my colleagues to address some of the other questions. Thanks.
Omea, can you do the freezes? Yeah. Or Darren.
Yeah, Philips Hospitality Trust, they'll release results tomorrow, so I have more updates on that. But other than that, yeah, I don't see any reason why the share price yeah. More updates on that once the results are out tomorrow. Thanks.
Yeah, for Centrum, I think the understanding is that the market is concerned of the margins that are coming up from the projects completed. So I think the market is very worried. The whisper is that their first half numbers or the margins might disappoint. And of course, the whole situation with oil price is also another concern. I think OPEC is having their meeting. I'm not sure they released it, but OPEC decided to increase production. I think probably just to appease Trump. I mean, that's the general political view, and that's going to keep pressure on. So we're not sure what OPEC is going to do. But again, it's just this oil price. There have been also mentioned in the industry of a lot of delays in a lot of projects. So that's the other concern. I think that was also mentioned during Capital briefing because they do own some REITs. So discussions on new FIDs has all been slowed down because with this type of oil price. Yeah, so the outlook in the very near term won't be that great lah. Yeah, I mean we're just stating the obvious. The share prices. Yeah, that's my own thoughts. Yeah, thanks. Yeah, sorry, not really follow Centrum, but yeah, but the margins is the big concern now. Yeah, I think the guidance is getting weaker. Yeah, okay. Yeah, hope it helps everyone. Yeah, because talking about Centrum is more like talking about oil price. So, yeah. Anyway, thanks everyone for your time. Hope everyone have a good week ahead. I think next Monday is Typosum. We won't have a session on Monday. We'll be followed by the following week. Yeah. Anyway, thanks everyone and have a good holiday break on Monday next week. Yeah. Thank you everybody and take care. Thanks for attending and for all your questions.